Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about KVUE. We are analyzing one of the most intriguing and, frankly, pretty risky merger arbitrage situations out there right now. It's defining the consumer staples landscape, Kimberly-Clark's acquisition of KVUE Inc. The deal was announced back on November 3rd, 2025, and right now the price action is defined by a spread so wide it screams uncertainty. KVUE is currently trading at around $16.93. The acquirer, Kimberly-Clark, that's KMB, is hovering near $103.
Mm-hmm. And when you actually run the math on the deal terms, which include a fixed cash component of $350 plus that fixed ratio of 0.14625 KMB shares, that gives us an implied deal value of approximately $18.56 per KVUE share.
Right. And that gap between the trading price of $16.93 and the implied value of $18.56, it results in a pretty significant $1.63 spread.
Yeah, which is huge.
Exactly. That 163 spread translates to a potential return of 9.6% if the deal closes today. I mean, for a standard M&A transaction in a sector like this, we usually see spreads in the, 2 to 4% range, reflecting time value and minimal regulatory friction. A 9.6% spread it's a flashing red light. So the central question we have to wrestle with is this massive spread accurately reflecting genuine structural deal breakage risk, specifically a regulatory catastrophe, or is it just an artificially inflated premium driven by, technical market noise and, frankly, profound investor confusion?
I'm firmly in the camp that the spread is grossly inflated by technical factors and market noise. I come at it from a different way. The data, I think, suggests that sophisticated institutional players are accumulating the stock with conviction, which indicates they see a clear path to closing. The fear being priced in here feels disproportionate to the actual legal risk.
I see why you'd think that, but let me give you a different perspective. I believe that 9.6% premium is absolutely necessary compensation for bearing some very high regulatory and structural risk. We're looking at a serious antitrust problem here. This isn't just about filing paperwork. The deal faces intense scrutiny from the Federal Trade Commission, and that's because of the horizontal consolidation in the baby care market. We're talking about merging Kimberly-Clark's massive Huggies brand with KVUE's Johnson's and Aveeno baby product lines. And this risk has historical precedent. It's like a sword of Damocles hanging over the whole transaction. If you go back to 1995, Kimberly-Clark faced a major DOJ lawsuit over monopoly concerns right after their acquisition of Scott Paper. That eventually required a mandatory divestiture. So that history, combined with the current, let's say aggressive, interventionist stance of the FTC against these kinds of horizontal mergers, it tells me the market is rightly pricing in the probability of a multi-year delay or even an outright attempt by the regulator to block the deal entirely.
That's a compelling argument, I get it, especially based on history. But the evidence from the current market flow suggests that institutional capital is looking past that historical precedent, or at least they believe the risks are manageable through some kind of remedy. I contend the spread is artificially wide, and it's driven by technical factors that obscure what is genuine institutional confidence. I mean, look at the flow data. We're seeing extremely high off-exchange short volume ratios. On December 5th, for instance, we hit 58.24% off-exchange short volume. Now, to a casual observer, high short volume looks fundamentally bearish, a bet on a price collapse. However, in this M&A context, high dark pool shorting it's usually characteristic of market makers facilitating large, long purchases by arbitrage funds. It's what we call the handover phase. Institutional ARBs, they want to scoop up millions of shares quickly, and the market makers temporarily short the stock off exchange to deliver that liquidity, and then they immediately hedge or cover those shorts. And crucially, the short interest itself, it remains moderate. The days to cover ratio, so how long it would take for short sellers to buy back all the shorted shares, is extremely low, hovering around just 1 to 1.16 days. That confirms this is high-velocity transactional flow, not a bearish conviction trade.
Okay, while that market flow analysis is intricate, I would frame that institutional activity differently. I mean, in terms of pricing the risk, arbitrages are sophisticated, yes, of course, but they only step in when the potential return, that 9.6% spread, is wide enough to compensate them for the significant cost of capital being tied up and the probability of a deal failure or, a prolonged delay. If they truly believe this deal was a near certainty, that spread would collapse to 2 or 3%. A 9.6% spread tells me that the institutional participants you're citing are pricing in a substantial premium for the possibility of, say, an 18-month regulatory nightmare. The institutional activity proves the risk is priced high, not that the risk itself is insignificant.
I think you might be confusing the symptom for the cause, though. The price action volatility in the acquirer, in KMB, that's the primary driver of the spread's current width, which is then just exacerbated by all this noise. Immediately after the announcement, Kimberly-Clark's stock dropped, 14–15%? That instantly dragged the implied deal value down from the headline number, which was $21.01 at announcement, to where we are now, around $18.56. Because the consideration is a fixed ratio of KMB shares, a lot of investors, especially retail, they don't grasp that the payout is a moving target. It's tied to the volatility of the acquirer. And that mathematical opaqueness, well, it creates inefficient pricing and a wider spread, totally independent of regulatory fears.
The KMB price drop is undeniably a major mechanical drag, I'll give you that. But we can't ignore the underlying fragility of KVV's valuation that made it so susceptible to extreme moves in the first place. Beyond the regulatory challenge, this stock has operated under a unique and really unquantifiable political duress. We saw the stock initially collapse to $14 months ago, and that was driven by fear of the RFK Jr. effect, the perceived threat of a government report linking acetaminophen, specifically Tylenol, to autism. And although this M&A deal temporarily mitigates that litigation tail risk by giving an exit, the fact that KVV's valuation was so acutely vulnerable to political narratives and unproven legal threats, it just shows it operates under some really difficult structural pressure. This demands a sustained, high-risk premium. The market is pricing in not just the antitrust risk, but the underlying volatility associated with a consumer staple company that's deeply exposed to litigation and political headlines.
Okay, but I challenge your focus just on the risk premium. Let's get back to the specifics of that institutional flow. When we look at that massive accumulation on November 25th, nearly 9 million shares shorted off exchange, this is the precise footprint of sophisticated capital moving in to secure a large position. They are demonstrating conviction that this trade is going to close. If they genuinely felt there was a significant chance of the FTC killing the deal, they would not be building enormous block positions that would suffer massive losses if the deal broke. They're just efficiently capitalizing on the volatility you just described.
I am still not convinced by the idea that institutional accumulation just negates the risk. It simply confirms the size of the premium required to take that risk on. And we have to return to the severity of the horizontal overlap, the combination of Huggies and Johnson's and Aveeno baby wipes. It threatens to recreate the exact monopoly risk that required the Justice Department's intervention and remedy back in 1995. Under the current FTC, which is highly critical of these buy-to-maintain strategies, the regulator may just use the 95 case as Exhibit A. This creates a very high probability that they'll either initiate a long, detailed 18-month review or just sue to block the deal entirely, citing Kimberly-Clark's repeated behavior.
I'm sorry, but I just don't buy that the 1995 case guarantees a fatal outcome. Let me tell you why the opposite is true. The historical precedent shows that divestiture is a viable and predictable path to approval. Kimberly-Clark agreed to divest the Scott Baby Wipes business in '95. They can, and they likely will, agree to sell off Kenvue's specific overlapping baby wipes assets now. This is a clear regulatory pathway. And furthermore, we have to consider the financial context. Kenvue's Q3 2025 fundamentals were weak. They showed a 4.4% volume decline, suggesting market share erosion and a need for, operational stabilization. This acquisition is strategically important for KMB to achieve portfolio complementarity, the whole paper versus liquid thing. Both companies have an extremely strong vested interest in seeing this deal close, which usually translates into a willingness to agree immediately to regulatory remedies like divestiture rather than face a long legal battle.
Okay, but the willingness to close only goes so far when you're faced with operational reality. The fact that KVUE was struggling with volume declines introduces a separate and major financial risk for the acquirer that the market has to be pricing in, Separate from the regulatory headache, Kimberly-Clark has identified $1.9 billion in cost synergies related to this acquisition, and analysts will universally deem that figure high execution risk. I mean, to put $1.9 billion into perspective, that figure is roughly 15% of KenVue's entire cost of goods sold and operating expenses. For a slow-growth consumer staples sector, achieving synergies of that magnitude, cutting 15% out of the merged operation, is extremely challenging. The market may be pricing in the very real possibility that KMB cannot achieve these massive cost savings without impairing the long-term value of the brands they just bought. If the synergies fall short, KMB's projected EPS accretion fails, which adds a layer of fundamental financial risk that justifies this persistent 9.6% spread.
The synergy targets are high, yes, but they're derived from a sound strategic rationale. It's based on that paper versus liquid complementarity. This allows for massive streamlining in the supply chain, distribution, and raw materials procurement, where the combined company has huge negotiating leverage. And crucially, the deal is expected to be accretive to KMB's adjusted earnings per share by the second year post-close. The evidence suggests the financial logic is sound, which means KMB has a very high incentive to push this through. The financial viability actually increases the likelihood of regulatory cooperation because the long-term economic benefit is clear. And moreover, KenVue already demonstrated good margin management in Q3 2025, even with that volume decline. They're a well-run operation, which suggests the synergy targets are ambitious but achievable through disciplined integration. This makes the risk premium based on execution skepticism likely overstated.
We've talked structural risk, financial risk, institutional flow, but we also have to acknowledge the massive retail investor sentiment that injects irrational noise and volatility into the stock. I mean, the general sentiment on public forums is overwhelmingly negative. Users who bought near the $22 IPO price, they feel like they are bag holders, cheated by the effective takeout price of around $18.56. In this frustration, it creates emotional selling pressure and volatility, which sophisticated institutional traders then leverage to create or widen the spread.
That is a very important point about market psychology, and it ties directly to the most persistent technical misconception that's scaring away retail capital, the reverse split narrative. I really want to clarify a critical historical point here. KenVue never executed a traditional reverse split. The confusion comes from the complex mechanism surrounding the J&J split-off exchange offer back in August of 2023. See, this was not a standard spin-off. J&J shareholders exchanged their J&J stock for KVUE shares at a very high ratio. It was 8.0324 KVUE shares for every one J&J share they tendered. Many retail investors and even some brokers misinterpreted this non-traditional equity swap as a share consolidation or a reverse split. They incorrectly linked the event to corporate distress or value destruction.
This misunderstanding just added layers of fear and complexity to a stock that already has opaque, floating M&A mechanics, and it's artificially contributing to the widespread we see now.
The fact remains, though, that whether the cause is structural antitrust risk, high financial execution risk, or just fundamental confusion over a floating consideration, the effect is a persistent 9.6% spread. So in summation, I believe the spread is fundamentally warranted. It accurately reflects the combination of regulatory obstruction risk, that critical baby wipes monopoly issue, and the volatility inherent in a floating rate consideration that's tethered to KMB's fluctuating stock price. This complex layering of factors makes KenVue a very challenging, high-risk arbitrage play subject to forces far outside the standard M&A realm.
And while I agree the structural and regulatory risks are significant, I believe the excessive width of that 9.6% spread is more attributable to transient technical noise, the severe volatility in Kimberly-Clark stock, and that widespread confusion over the floating deal mechanics and complex corporate history. The institutional accumulation that we see through the low days to cover and high dark pool turnover, it suggests to me that professional capital is successfully navigating this noise with high conviction in the eventual closing, most likely through a divestiture.
In complex M&A, particularly where high regulatory risk intersects with these market microstructure distortions, determining the true risk premium remains intensely challenging. The market is really asking investors to make a definitive choice between prioritizing legal precedent or technical flow.
Indeed. By weighing the specific evidence, historical antitrust behavior versus current institutional trading patterns, investors just have to decide which specific risks they are more willing to bear to capture that $1.63 premium.
This discussion has clearly illustrated the competing forces driving the KVUE price action, highlighting why that arbitrage spread remains so stubbornly wide. Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.